For years, the pursuit of profitability has dominated the financial world, leaving a fundamental question in the background: what about sustainability? Today, those who manage to align responsible investment and financial returns hold the key to a stronger and more resilient future. Green bonds open a path to channel capital toward projects that not only boost profitability but also protect the planet's resources and strengthen economic stability. This journey provides the clarity needed to understand how green and sustainable bonds are transforming the financing architecture, providing rigorous perspectives for evaluating real opportunities. Because those who understand these dynamics have an advantage in the face of regulatory changes and the growing environmental pressure that will shape the course of business in the next decade. Green bonds, also known as green bonds, emerged in 2007, driven by multilateral organizations seeking to finance clean energy and environmental efficiency projects. Their structure replicates that of traditional bonds, but with an explicit commitment to allocate funds to initiatives capable of mitigating negative climate impacts or improving natural resource management. The growth of this type of issuance has been exponential, driven by both institutional investors and increased regulatory demands worldwide. Demand has grown stronger year after year, thanks to the convergence of regulatory incentives, social pressure for climate action, and the returns these instruments can offer relative to other fixed-income assets.
The essence of green bonds lies in delivering a dual return, financial and environmental. On the one hand, they guarantee the buyer a competitive return; on the other, they offer the certainty of participating in projects with measurable and traceable environmental benefits. This combination explains why so many investors are incorporating them into their portfolios. Despite this, significant challenges remain, especially regarding the standardization of criteria and the verification of financed projects. The risk of greenwashing, that is, presenting projects as sustainable when they do not actually meet real environmental objectives, remains a threat that requires solid regulatory frameworks, independent audits, and reliable traceability systems.
Green bonds are not a marginal resource, they now represent a fundamental element in the transition to a low-carbon economy. The progressive increase in their global issuance over the last decade confirms that this is not a passing fad, but a structural response to the environmental and energy crisis that challenges all of humanity. This scenario is paving the way for a profound transformation. Sustainability has ceased to be a reputational bonus and has become an essential requirement for accessing international financing. Investing in green instruments is emerging as the best way to protect portfolios against regulatory risks, sanctions, and growing citizen pressure for responsible production models.
Beyond the aggregate figures, these instruments are making a tangible impact on the lives of millions of people. Financing renewable energy, clean transportation, resilient infrastructure, and waste management projects creates quality jobs, boosts local supply chains, and strengthens technical capacities in regions that traditionally lacked sustainable investment alternatives. In developing countries, the arrival of green bonds has a multiplier effect that goes beyond reducing carbon emissions. It favors the creation of job opportunities, technology transfer, and the consolidation of productive ecosystems with a lower environmental impact. This triple win, economic, social, and environmental, defines the transformative potential of sustainable bonds.
A key aspect in the expansion of this market is trust. Investors demand guarantees that funds are truly meeting their stated environmental goals. Today, technologies such as blockchain are helping to track resource use in real time, offering a level of transparency that was unthinkable just 10 years ago. The combination of increased regulatory oversight and tracking technologies is accelerating the maturity of this market. This gives confidence to both large investment funds and local players looking to enter the world of green finance, with clearer mechanisms, uniform rules, and a more accessible flow of information. The sectors that have benefited the most so far include renewable energy, sustainable transportation, energy efficiency, and waste management. All of these not only provide climate benefits but are closely linked to the stability of local economies. In practice, they reduce dependence on fossil fuels, improve the quality of life in congested cities, and minimize public health costs resulting from pollution. It is undeniable that, although the green bond market is making steady progress, significant challenges remain. These include geopolitical volatility, inflation, and tightening monetary policies, factors that can make access to sustainable financing more expensive. Regulatory fragmentation at the global level is also a concern. While the European Union and North America have clear and relatively consistent standards, other regions of the world still lack standardized rules, creating uncertainty for international investors seeking uniformity and legal certainty. Despite this, the medium and long-term outlook is encouraging. Many countries are already designing tax incentives and subsidies to facilitate the purchase of green bonds, with notable examples in Asia-Pacific and Latin America. These policies allow more and more sustainable projects to access capital at competitive rates, reducing the associated financial risk. Additionally, the emergence of social bonds and sustainability-linked bonds expands the range of responsible instruments and contributes to creating a more diversified investment ecosystem. Investors are thus not just seeking yield, but also valuing impact and alignment with long-term goals. For a professional with a solid academic background, understanding how these bonds work and how they differ from other financing tools can provide a huge competitive advantage. The ability to anticipate regulatory changes, identify projects with true environmental value, and build diversified portfolios that are resilient to global crises will make a difference in the coming years. Thus, green bonds represent much more than a novel financial product. They are an essential element in rethinking how we relate wealth and collective well-being. Through them, private capital becomes a driver of structural change, directing resources toward activities that improve the quality of life and preserve ecosystems. This cultural and financial shift holds the opportunity to transform not only profitability but also the legitimacy of the financial system itself. Investors in the next decade will increasingly be forced to justify their decisions to regulators, clients, and citizens concerned about the future of the planet. In this sense, green bonds act as a bridge between public trust and financial innovation, demonstrating that profitability and sustainability are not enemies, but strategic allies. Climate change, biodiversity loss, and growing social inequalities have forced a rethinking of traditional global financing mechanisms. In this context, green, social, and sustainable bonds have emerged as innovative instruments capable of mobilizing large amounts of capital toward projects that promote environmental and social sustainability. The Organization for Economic Cooperation and Development, OECD, has noted in various reports that these financial instruments are essential for advancing sustainable development, as they allow environmental and social goals to be linked to the stability and growth of financial markets. This relationship between sustainability and finance not only responds to an ethical imperative but also constitutes a pragmatic strategy to mitigate systemic risks and seize long-term economic opportunities. Today, more than ever, investing is no longer just about making a profit, but rather being an active part of a process that will determine the quality of life of future generations. The challenge, and also the opportunity, lies in taking advantage of this new financial architecture to drive development that doesn't compromise the planet's limited resources. Subscribe and comment on what other global sustainable investment opportunities you'd like to discover, so we can continue analyzing together the role of responsible finance in a world demanding profound changes.